Budget 2026 will be announced on Tuesday the 7th of October 2025. Amid a period of global economic turbulence, this year's budget is expected to be more restrained than previous recent giveaway budgets. It will predominantly feature increases to public spending rather than tax cuts, with a focus on delivering infrastructure projects. There are likely to be more targeted measures rather than the universal payments of previous years to deal with the cost of living crisis. As usual, the final negotiations around the budget are expected to go down to the wire. Media soundings around VAT, R&D tax credits, pension reform and investment fund taxation are in circulation. Our tax team have prepared a number of summaries based on everything we expect so far from media and government briefings, and from what may still be hoped for on the day itself.
The stakes are high for Budget 2026 in this rather uncertain global economy. While our tax regime is attractive to foreign investors, the competition from other countries is intense. Budget 2026 will include tax reforms to make it easier for multinationals to operate in Ireland. These will include improvements to our new exemption for foreign dividends, simplification of our interest deductibility rules, and enhancements to the Special Assignee Relief Programme, an incentive for foreign executives coming to Ireland. We will also see support for Irish businesses trying to target new foreign markets. This is likely to include improvements to the Foreign Earnings Deduction, or FED relief. FED is designed to help Irish-based employees who spend time working in certain countries in the Middle East, Africa, Asia and South America.
Last year, we saw an increase to the tax-free thresholds for gift and inheritance tax for the first time since 2019. Currently, if a child receives gifts or inheritances from their parents, they pay no tax on the first €400,000, but then 33% capital acquisitions tax on everything above that threshold. While there have been calls for the tax-free thresholds to be further increased and for the small gift exemption of €3,000 per year to also be increased, the Minister for Finance has noted that there would be a significant cost in making any further substantial changes to gift and inheritance tax. It's therefore unclear if there will be any substantial increases to the tax-free thresholds or small gift exemption in this year's budget. There have also been calls to decrease the headline rate of capital gains tax, which is currently 33%, but it's unlikely that there will be any significant change to this in the upcoming budget.
Budget 2026 comes against the backdrop of economic uncertainty brought about by the introduction of trade tariffs by the United States, including 15% on goods from Ireland and the rest of the EU. The VAT rate on the sale and construction of new apartments may be cut from 13.5% to 9% to make building more viable. This will be a welcome change for the construction industry, although it could be difficult to administer in mixed-use developments. We may also see reforms to residential zoned land tax, RZLT, and the extension of the stamp duty residential refund scheme to make housing development more affordable. We are likely to see a reduction in the VAT rate for the hospitality sector from 13.5% to 9%, although this could be delayed until July 2026 to free up funds for other measures. The reduction may only apply to restaurants and food-serving businesses rather than accommodation, which is likely to cause some operational complexity in the sector. The government is said to be exploring ways of excluding multinational chains from the reduced rate, although this would introduce further complexity and could lead to legal challenges.
Despite €1.5 billion being provided for tax cuts, it has been announced that it will be challenging to cut income tax rates, and as such we can expect modest increases in the standard rate income tax band, as well as a reduction in the universal social charge. Owing to the uncertain economic climate caused in part by tariffs introduced by the United States, it would be welcome if measures to support SMEs were enhanced. In particular, as the ceiling for entrepreneurs' relief remains at the level of €1 million introduced in 2015, and as retirement relief for disposals to third parties remains at the higher level of €750,000, which is in place since 2012, increases to those limits would be welcome in the SME sector and assist activity. Enhancements to the R&D tax credit to support all forms of innovation and support global collaboration, and the provision of better access to the Employment Investment Incentive Scheme would also be welcome measures to encourage innovation and support the business. As a global player in the capital markets, it will be beneficial for the 8-year deemed disposal rule for Irish domiciled investment funds and life products to be removed, as this rule, which taxes unrealised gains every 8 years, is a disincentive to investment in funds. An alignment of current tax regimes to ensure that investors are not penalised for investing in funds, which are subject to an exit tax of 41%, over investments which are subject to CGT rates of 33%, would also be a welcome development and assist activity.
We would welcome a simplification of the tax code in Budget 2026. Earlier this year, the dividend participation exemption was introduced. This has already removed a huge amount of complexity for those Irish businesses with foreign investments at no cost to the Exchequer. In our view, this momentum must continue. Did you know the tax return for Irish companies was just 22 pages in 2010 and is now 62 pages long? We would welcome an abridged version for smaller enterprises, perhaps with revenue aligning the definition of micro, small and medium-sized enterprises with a CRO, and allow companies that fall into the micro and small categories file this simplified style tax return. This will reduce both cost and complexity, again with no cost to the Exchequer. An additional administrative burden imposed on companies is a requirement to file payments which meet certain criteria on an information return known as a Form 46G. Failure to complete this return correctly can result in the company incurring a penalty of €3,000, the loss of tax clearance, and a restriction on the use of corporation tax losses. Similar to our call for a simplified corporation tax return, we would encourage an exemption from companies who fall within the micro and small categories from an obligation to file this return. The new real-time reporting rules for expenses paid to employees are undoubtedly beneficial to revenue in terms of the information provided and time savings costs. However, they can be time-consuming for employers and easy to overlook. An option to allow SMEs to file these expense returns on a quarterly or annual basis would help to reduce both administration and errors, which again come with no additional cost to the Exchequer. Many businesses investing in Ireland find some of our tax incentives hard to understand and too onerous. Some incentives, such as the digital games credit, the knowledge development box, and keep share schemes, are so complex and impractical they can rarely be used. A more practical approach to these and other incentives will be of significant benefit to Irish SMEs and to the Irish economy.
For further information on Budget 2026, please refer to our budget highlights and insights on our website at ByrneWallaceShields.com.